The banking system, fractional reserves. John's empire is expanding. His keyboards are no longer just a hobby. They're the centerpiece of a growing venture he calls neo-finance. For the first time, John faces a high-level problem. He has a significant surplus of cash. He has $10,000 in currency sitting in a secure digital terminal in his office. He knows that in a melancholic, advanced economy, cash is a tool that shouldn't sit idle. He decides to take this capital to the local bank. As he enters the sleek, dark blue lobby, he believes he is simply renting a safe. In reality, he is about to become a critical component in the economy's most powerful engine, the money creation machine. To understand what happens to John's $10,000, we must look at the mechanics of the banking system as described by N. Gregory Mankiw. At its most fundamental level, a bank is a financial intermediary, a middleman that connects people who want to save with people who want to borrow. When John hands over his $10,000, the bank records this on its balance sheet, often called a T account because of its vertical and horizontal lines. On the right side are liabilities, which represent the money the bank owes to others. John's $10,000 is now a demand deposit, a liability for the bank because they must pay it back whenever he asks. On the left side are assets, which represent what the bank owns or is owed. In a hypothetical world of 100% reserve banking, the bank would take John's $10,000 and lock it in the vault. Its assets would be $10,000 in reserves, and its liabilities would be $10,000 in deposits. In this scenario, the money supply, the total amount of currency and deposits available for spending, remains exactly $10,000. No money has been created. It has simply changed form from currency to a digital entry. However, the modern world operates on fractional reserve banking. The bank's managers know that it is statistically impossible for every depositor to show up at the exact same moment demanding all their cash. Therefore, they only need to keep a fraction of their deposits as reserves to handle daily transactions and withdrawals. The rest can be put to work. Suppose the bank has a reserve ratio of 10%. This means they keep $1,000 of John's money in their vault and lend out the remaining $9,000 to someone else. Let's say a developer named Mike borrows that $9,000 to buy high-end servers for a new delivery app. This is the pivotal moment of economic creation. John still has $10,000 in his checking account. He can write a check or swipe a card for the full $10,000 to buy keyboard parts. But Mike now has $9,000 in currency to pay for his servers. The total money supply has jumped from $10,000 to $19,000. By lending out a portion of John's deposit, the bank has literally created money. It is important to note that the bank has not created wealth. Mike's $9,000 in cash is balanced by a $9,000 debt he owes the bank. But the bank has increased the economy's liquidity, providing more medium of exchange to facilitate trade and growth. The process does not end with Mike. Mike pays a server manufacturer $9,000. That manufacturer then takes the money and deposits it into their own bank, Second National Bank. This second bank also follows a 10% reserve ratio. They keep $900 in reserves and lend out $8,100 to a third borrower. This $8,100 is eventually deposited elsewhere, where 90% of it is lent out again. This chain reaction is known as the Money Multiplier effect. Each time a dollar is deposited and a portion is lent out, the total money supply in the economy grows. The amount of money the banking system generates with each dollar of reserves is called the Money Multiplier. As Mankiw notes, the multiplier is the reciprocal of the reserve ratio. With a 10% reserve ratio, the multiplier is 10. This means John's original $10,000 deposit can theoretically expand the total money supply by $100,000 as it ripples through the system. If the reserve ratio were higher, say 20%, the multiplier would drop to 5 and the money creation process would slow down. This is why the reserve requirement is such a potent tool. By changing how much banks must hold back, the architects of the economy can control the speed of the entire financial engine. For John, this realization is transformative. He sees that his savings are not a static pile of cash, but a dynamic force that is being multiplied and distributed to fund innovation across the city. He also begins to understand the delicate balance of the system. The bank faces a constant trade-off between profit and liquidity. They want to lend as much as possible to earn interest, but they must maintain enough reserves to satisfy depositors. If a bank is too aggressive and lacks liquidity, it risks a bank run, where panicked depositors all try to withdraw their money at once. John realizes that the money he sees on his screen is only as stable as the loans the bank has made to Mike and others. The stability of his wealth is woven into the health of the entire banking network. As he leaves the bank and steps back into the neon-lit streets, he no longer sees a building of stone and security. He sees a high-tech laboratory where capital is synthesized and the lifeblood of the economy is manufactured. He is now ready to understand who supervises this laboratory.